following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the show. I'm Victor McClure.
Or welcome back to the show. That's okay.
I'm your host and the president of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard.
What's going on? Good afternoon, all. And I'll warn the listeners, Victor's fighting allergies, so if he sounds a few octaves lower today, it's true.
If I lose my voice during this, you're going to have to take over.
Have to take the baton.
Remember, we developed this show to answer your financial questions. I've had a lot of discussions with other advisors the last couple of weeks, and it just amazes me what they don't know. And I'm not saying we know everything either, but I'm saying is most brokers or advisors are taught to sell what they have available to them only. And if that's a big company, you think a bigger company has more products. It's actually a narrower product line. But they'll know about that, and they'll throw out a couple talking points maybe about other things, but really not know any details about things. And we've always prided ourselves here at Dillon Gage to knowing everything that's available out there.
Well, there's a whole host of problems with that. Obviously, the least of which is if you only know one product and you're selling one product, how can you make the whole plan dovetail together where you've got income and you've got securities and you've got some fixed income stuff? And what do you know about REITs and these private placements that are illiquid? And should I do these? But it's all focused and everything should go in what I'm telling you and what I'm talking about, right?
But it's amazing to me. Don't get me wrong. People who've been in this business a long time are probably pretty successful at it. And they're going to sound pretty good. They just know enough, usually more than the typical investor. But when you go deep, that's when you'll have problems. That's why I like all my engineer clients. They always go really deep. And they say, well, you're the first one to be able to answer that question. You should be able to answer every question for a client, period, if it has to do with finance. Now, if they start talking to you about, Obamacare and you have nothing to do with that, that's a different story. Speaking of Obamacare, another government agency has decided to touch our business.
Regulate our business a little. And before you go, let me preface it. Most all Americans, in one shape, form, or another, have one federal agency that they have to deal with, and it's a pain in the patootie, right? The IRS. Right. And it's coming up now, the 15th, right. Friday coming up. If you haven't filed your taxes, you need to. But that's enough, right? Right. How many do we have?
We have 4, and the IRS.
Well, yeah.
That's 5, right? Yeah. So we have 4 different government agencies. What you have is the SEC. Everybody knows that. That's a U.S. government agency. Then you got FINRA, which is the self-regulatory body, which is in many ways, about the same. And then you've got the state securities boards.
That's right.
Then you've got the state insurance boards. Those are the 4 government agencies that monitor you. Like I said, if you ever had a business, a company that has anything to do with government contracts or anything like that, you know the kind of stuff you have to do and how much money and effort and time you have to pour in just for regulations and paperwork.
And apparently 1, 2, 3. Apparently 4 agencies are not enough, right?
Obama couldn't get anything through those 4 agencies, him and Elizabeth Warren, on stuff they wanted in our industry, so they went to the Department of Labor. So now the Department of Labor is involved. So now I guess we're going to be audited by 5 government agencies.
And it's specific to IRAs and retirement accounts, which whether that's good or bad isn't the point. Everyone should be compliant and should have a set of rules, and it should be uniform. But the problem is you had 4 other agencies to pick from, right, that could have shouldered this extra little burden, but no, it couldn't happen quick enough for Obama. I've got to have it done today, so let's go to the DOL.
So sometimes regulations are good for the consumer. Sometimes they have unintended consequences, and it remains to be seen how this one will shake out. I don't want to go into it too much, but it's just difficult, when you're doing business and another agency creeps in, and another audits and other things like that. That's why they've been pushing out small independent firms for years. That's why you've seen consolidation of the banking industry, the finance industry, things like this, because it's so onerous, the amount of money and time you have to spend on just compliance, that it makes it difficult. And so you'll see less and less, in my opinion, you'll see less and less of the independent types like us, more and more of the big firm types.
Well, the independents like us will probably be around, but the smaller independents, not so much. And, our expense and other wirehouses' expense with having to deal with a fifth agency is one thing. But keep in mind, all of you listening, your expense goes up too. Why? The government just got a little bigger. DOL's got something else they've got to do.
I mean, I'll give you an example. My cousin works for a big firm right here in Dallas, really big firm. You know the name. I'm not going to mention it.
Oh, go ahead.
But if you have under $2 million, you have to go to the bullpen. Now, don't get me wrong. I went to his wedding, and he works in the bullpen. These guys are all young hotshots, a lot of Ivy Leaguers, things like that. Theoretically, pretty smart. Not much practical knowledge. But if you're under $2 million, that's who you go to. You don't get the corner office guys, even the first level of corner office guys, or actually single office guys. How about that? Until you get over $2 million. Everybody else is in the bullpen where you got everybody out there. You're kind of like a customer service area. Now, they're licensed. Not as good, obviously, as a corner office guy that's been doing it for 30 years.
Think cubicles.
Yeah, and that's why I like when you're dealing with us, you're always dealing with the corner office guy. Don't get me wrong, we love $100 million accounts. But I don't care who you are. We're going to give you great advice to the best of our ability.
Yeah, and even if it's not appropriate for us and if the account's really small, we're very good at pointing people in the right direction. Have a lot of clients that have children getting started in different things. And we usually try to point them to the place where it's the least amount of fees and
yeah,
such.
I get this all the time. I can't believe I asked you, I wanted you to be my advisor, and you said I'd probably be better off at this point at Vanguard or something.
Right.
I go, well, in your situation, that's what it dictated. I'm not going to try to take your account even though you want to, because you're not better off somewhere else. I had a deal where we had a broker-dealer, and a customer was saying, well, I want to stay with this broker-dealer, but I said they're charging like $400 a month. And I'm the one receiving the funds. This was a few years ago, right? And I said, I think you're better off just going to like an E-Trade or something like that because you know what you want. You know you want to hold it. Why are you paying somebody for that? You're not really using advice on this particular account. So it's better to go somewhere it's cheaper. Just make sure there's bid and ask spreads and all that. Make sure you're getting the best price. But as long as you're getting that, pay the less money.
I've even sat on the phone with them on a conference call and walked them through either the online setup or working with a customer service rep from one of these other groups just so that they could get started.
Yeah, this doesn't mean we don't want to help everyone or we don't want clients. Obviously, we do. That's why we do this. That brings up a funny story. I had a client tell me their broker from another firm said they would do a similar strategy to what we were talking about, but they said they're not going to make anything on this. There's no commission going to be paid.
Oh, yeah.
No
Mention them by name. I remember the email.
And I was like, are you kidding me? I go, I know what is paid to someone on those products. And it doesn't matter what firm you work for, that is paid. Now, I don't know what your split is or whatever, but somebody's saying they're not getting compensated. Because I didn't realize that this big firm was a nonprofit because everybody's getting compensated. You don't do this for nothing, even though there's some, reasons why you would do financial planning, to help people. It's not all about money, of course. But I'm telling you, you're not doing it for free. If anybody tells you they're doing it for free, now their information is suspect, period. So that's what you always have to understand is everybody gets compensated. But what I find out is, what are you compensated? Is it fair? Is it reasonable? Is it commensurate with the industry? If it's way out of bounds, then you have to really be saying, wait a minute. If the industry charges this and you're charging 50% more, 100% more,
that's right.
Why?
Now, one of the things we offer at no cost or no obligation, and you hear us talk about it all the time, is our financial analysis, the Social Security review. But we do that to help, and if we can fit in and we can structure a plan, the things that we like to do later in the show today, as we get time, maybe we can go through some case studies. But we help get all these things organized. Your pensions, the Social Security, find out what you're going to need in retirement, what the shortcoming may be, how long the money is going to last, what your tax is going to be. So we're more than happy to provide that free analysis so you can shed light on the issue.
Yeah, and what we're going to do later on the show is we're going to go by a couple of cases that we've had here over the last few months, and just to show you how this plan works. Now, remember, our retirement planning, our Social Security optimizing, there's never a cost or obligation. It'll give you a roadmap to retirement, something that you can't. It's hard to understand now what your life's going to look like when you're 80 if you're 55 now. We will show you that. We'll show you the effects of inflation on your portfolio, what your expenses are now versus what they will be 10 years from now, 20 years from now, and so on. All of that, like I said, is included in that package. You can take that with you, whether you did business with us or not. Our number, again, 972-715-2424. Again, 972-715-2424. You can go to ilovemyretirement.com. There's some good videos on there. Stay with us, folks. We have a break coming up. You're listening to the Common Sense Investing Show on News Radio 1080, KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome to the show. This segment, we're going to talk about something near and dear to all of us, Social Security.
And retirement. May we get there.
There's been so many different things. Are they going to raise Social Security age? Are they going to means test it? What are they going to? Is it going to be there? I better take it now because, it probably won't be there later.
How many Americans need it? Who
That's
doesn't?
Right. Is it your money? That's another thing that came out. Remember, it used to be, well, I put the money in there, and they used to not spend it. Now they spend it all right.
Oh yeah.
I put the money in there. Why can't I get it out? Well, I mean, why are you limiting that for me? But now they said, no, it's not your money. I've heard the Democrats come out lately. It's not your money. It's never been your money. What? It's just a benefit we may pay you. I'm like, holy crap.
What election was it where the big talking point was the lockbox? Was that, I forget if that was Bush or who it was. The Social Security, it's going to be a lockbox. We're not going to touch it. Everything, remember? It was a big talking point. For a year we heard that, and no lockbox.
Somebody unlocked it.
I know. There's no lockbox to be found anywhere.
The box is sitting empty with the lock sitting next to it, right?
We thought we'd take a minute or two, or a segment or two, depending on how it goes. There's a periodical called The Here and Now, and Jeremy Hobson is kind of the writer, and he oversees it and gets the material. And he talks about the American retirement system, how well prepared people are financially, how secure the Social Security system is, how to reform it or return it to where it was, and a few things. And he interviewed a couple of interesting people. Now, as we go through some of their thoughts and capsulize it for you, you'll know who the Democrat is of the two, because they're always talking about, well, we can solve it by raising taxes. But Alicia Monell, if I'm pronouncing it right, is the director of the Center of Retirement Research at Boston College, former assistant secretary of the Treasury under Bill Clinton, and also John Leitner, professor of economics and director of Michigan Retirement Research Center at the University of Michigan. So it's two fairly sharp people, spent their life researching and working on retirement and numbers. And they went on to say, and they prefaced it, this may be shocking to some, maybe not, but about half of all American workers are not financially prepared for retirement, savings, etc. Pension plans, Victor and I have talked about this a few times, are disappearing. Everything is 401k based now, more so than having what would be a defined benefit, and you worked for the same company for 30 years. And part of the reason, as we'll get into through these interviews, is people move jobs more now than before. I don't know if that's a millennial thing or just a sign of the times, but you don't have that mentality where you go to work for one of the big companies, Big Blue, and you stay there for 30 years or so. So a lot of Americans right now don't have access to retirement accounts, and that really puts the onus on individuals. And I'll just take a moment. One of the things that we pride ourselves on is helping people take care of that pension, income solution, retirement solutions ourselves. We always talk about, and we believe it, and it's a passion, is to take care of your hard expenses. If you do it, whether you're doing it through your 401k and you can shift that into retirement, or whether you do it in addition to or instead of, if you don't have that available to you, it's a big deal. And if you have any questions on that, or you just want to chat about it a little bit, our number is 972-715-2424, and we'd be happy to talk to you about that. All right. The interview highlights with Alicia Monell and John Leitner. The first question is, how would you rate the current state of retirement in this country? Alicia said she was a professor type, and she would say the current state of our retirement she would give a C- to. And she talks about people are not going to be able to maintain the same standard of living once they get in retirement. So think about it. We all think about downsizing for convenience, because you don't want to clean such a big house. The kids are gone. You don't need that. But just the fact of in retirement not being able to maintain that same style of living is kind of sobering. Leitner, real quick, I know we've got a break coming up. A little bit more optimistic. He gave the system a B rating, and one of the things that and we'll talk a little bit more about, is that people are living longer, which is certainly a good thing, but in living longer, you also need more money in retirement.
Yeah, the longevity thing is, it shouldn't be a problem. You're living longer, that's good, right? Well, you need more money if you live longer. Inflation affects you more as you live longer. Healthcare costs affect you more. Everything affects you more as you live longer. And so you really have to, that's why we like the guaranteed income solutions that guarantee things for life, because you have no idea. It doesn't matter if your parents lived to 70, 72, and you think there's no way you're living past 70. You might be. They'll keep you alive longer than you want to be alive nowadays. So you got to be able, or when one of them goes to long-term care facility, like a nursing home, the other one still has the same bills coming in. And now you got to pay another $7,000 a month for a nursing home, and it can completely wreck families. And there's not much you can do about it sometimes.
Part of the stuff that contributes to that is the fact that interest rates are so low, and like you talked about, healthcare cost. You have no idea. Healthcare cost is probably one of the hardest things to project for retirement.
Right. And that's why I always tell you, you got to have a good retirement, insurance policy and all that kind of stuff as you retire. But you got to plan these things. That's the most important. You got to plan for all this stuff. We'll talk about more of this Social Security report here when we return from the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. As you can hear from my voice, I'm fighting off something here.
You're hanging in there, though.
Today we're talking about Social Security. A couple of professors are discussing what we need to do about America's retirement system and Social Security and things like that. And go ahead and we'll go right back into it, Guy.
Yeah, one of the questions that was asked to both professors or statement that they commented on was, some argue that a way to work around the issue of living longer is to have people working longer. And they went on to comment, which is true, that working longer is a powerful solution because it does a lot of things, Victor. We talk about it a lot. One, it lets your money in your 401k defer longer. And when it defers longer, it grows. Two, obviously, it provides a real good income, takes care of the health care that you need. Minimum, right, should be working at least until you can get to the Medicare point so that you don't have to augment the Social Security or the healthcare system.
Yeah, a lot of people, it's a huge percentage of people take Social Security early. It's a burden they hand kind of mentality. They don't realize how much more it is if you wait. We do an analysis for people all the time. It says if you take it at this age, here's what your lifetime benefit is if you live to this age. And because what they'll always do is simple interest. They'll think of simple math. In other words, I have accountants that do it. They'll say, oh, well, it takes you to 78 to break even. Well, none of my parents ever lived past 78, so I'm taking it now. And the truth is that's without cost of living adjustments. If you put cost of living adjustments, you're getting cost of living adjustments on higher amounts of money, and it makes a huge difference. Same thing with your retirement planning. If you take retirement planning, people do the simple way. I need $2,000 a month. That pays all the bills. And they factor that in. They go, okay, $2,000 a month. It would take me 25 years. I'm good. They did not factor inflation into the mix at all. Even minor inflation, your expenses are going to almost double in 20 years.
And it's like most anything. When you put a number to it, you know it's going to cost more in 10 years than it does now. But when you put a number and you see it in black and white in front of you, it makes it a lot easier. And it makes it clear. It clears it up for you. All right. They also talked about is raising the age for Social Security a solution. And they went on to comment that they call it raising the age, but what they really is a benefit cut opposed to just raising the age. And also backtracking a little bit, just a good number for you. If you take Social Security at 70 opposed to age 62, you get a 76% increase, 3/4 the amount. So again, if you take it at 70 opposed to 62, you get a 76% increase. So if any way possible, I always tell everybody, and the joke, Victor, is I'm going to work to 70, but I reserve the right to change my mind at 65. Right?
The one thing to think about, too, is people don't realize when let's say it's a husband and wife. Let's say the husband's got a higher Social Security than the wife, okay? They don't realize that higher Social Security, the highest number you have, is the one that will continue with one of you pass away. And so not factoring that in can be a big mistake in your retirement planning. You got to say, all right, I know it's only $1,200 a month at 62 and $2,000 a month at 70 or whatever, but I'm taking the $1,200. But if some of you passes away, you're only keeping $1,200, your maximum. The other one, if it's $1,000, will drop off. And so you'll only keep $1,200. And in the other case, you not only would you have got 76% more income, but that's forever.
That's right.
Remember, a couple, when they reach 65, have a good shot. One of them gets to 92. An individual might not have that long of a lifespan, but a couple does. So you can't think of things of just me. It's got to be this couple unit. So what is the best for that? And that's why our retirement analyzer will show you that. Remember, if you'd like to take advantage of that, it's 972-715-2424 or go to ilovemyretirement.com.
Another quick point. We've all heard about means testing Social Security. In other words, if you make too much, you won't get it. And even though you've contributed it, they discussed that a little bit. And Leitner made a very good point. The fact that the more you make, the more you contribute, and you don't get the benefits
it's like $1 for every 5 above a certain. So
that's right. As someone lower, it's pretty much already means tested. You put more in if you make more, and you don't get quite as good a return, the benefit ratio, as you do on the smaller side. The other question everyone asks, what needs to be done to Social Security so that it still exists when people retire? And they talked about the gap between promised benefits and the revenues that are coming in. And the Clinton former administration said, well, we just need to raise taxes and fill the coffers up so that we can, pay the benefits. I don't know that raising taxes is the best thing, but some adjustments do need to be made for it to work. Even Leitner mentioned perhaps a slight increase in age so that the benefits will be there. They went on to talk about auto IRAs, and apparently a few states, California leading the way, are already starting that. I'll finish up briefly on that when we come back after this segment's over, and then we can go into some case studies if you want, Vic.
All right. Sounds good. Remember, folks, if you'd like to take advantage of our no cost, no obligation retirement plan, retirement stress test, and Social Security Optimizer, don't hesitate to call our hotline, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. We're going to wrap up the Social Security thing, and then we're going to go into some case studies. We're going to talk about a couple. I've changed their names to protect the innocent.
Dragnet, remember that?
But we're going to talk about a couple in Plano here that we did analysis for and see what our findings were.
Change your name, but you're not going to change your address? What's up with that? No. All right.
Maybe it was Frisco.
Yeah. All right. Where was I? You got me laughing again.
Auto
They were-
IRAs.
Yeah, auto IRAs. They were talking about some employers not providing 401ks. We talked earlier on in this article, half of the Americans, sometimes it's 2 out of 3, but we'll use half of Americans aren't prepared. They don't have 401ks. And of course, the government wants to step in and make sure that this problem is resolved. And they're talking about auto IRAs, and what they're talking about and what they're thinking is something that would start with a 6% contribution rate. Mandatory, it'd be kind of like a tax. You'd get your taxes out of your check and the whole
So your
thing.
Social Security, you got to
Right.
take another.
Yeah,
6%,
you're seven
right?
and a half. The total 15% is coming out of your, and now another 6%
right.
automatically going into
More government always helps. Right?
into a retirement account. Now, once that retirement account gets big enough, they'll probably take control of the money for you, right? No, that's not the plan. But yes, it would be an additional 6% on top of everything else, mandatory. And then they talk about an automatic escalation rate, and they use maybe and kinda and should be something like a 10 to 11 to 12% rate. So you can kind of see what's happening. You can almost see a transfer of liability and responsibility from the government Social Security plan into your own. Now, personally, if they would have done that 35 years ago and that's what we had, I'd be okay as long as I got to have control of it. But I don't know how. But anyway, so that's what they're talking about. And there's a few states right now. They say California's in the lead. Connecticut, Oregon, and Illinois are starting to set up state systems where those who do not have a retirement savings plan at work will have a mechanism which they can now save. Or
See,
the
I don't
government
like
can
that.
save.
Anytime the government gets involved, it screws everything up, period. You know, remember they said this Social Security is going to cover everything. We're never going to tax it. Oh, then they taxed it. We're never going to spend it. Then they spend it. We're never going to raise the income rate. Then they raised it.
Wasn't it Roosevelt that implemented it and you're trying to get the senior vote at the time?
Well, you just can't. Once they get involved, it's it. I'm pretty. I mean, then you got Bernie Sanders wanting to tax you about 90%. I mean, what is there anything left?
Well,
to buy groceries?
I got to stop. If you make $140,000 a year, let me repeat this. No matter how much taxes you're paying, you will owe another $40-some thousand a year on your 140 if you elect Bernie.
I know, and you're already paying about probably 30. So basically almost tripled your taxes. It's like, great. So, and that's to pay for a little bit of the stuff.
And once you get that rate, it's impossible to reverse it.
No. So, all right, well, let's talk about a case study. This person come in, it's Joe and June from Plano. The J&J couple, I guess. What we did, Joe is 65. June is 62. June is still working. Joe is now retired. He was on disability. Had some issues. And so he's getting a disability check. He was getting it for a few years, but now he's going to get just Social Security and all that stuff. We looked at their portfolio. They, like I said, they don't want to take a lot of risk, but think they might have to because they might have a little shortfall. Around $1.1 million.
Did you put it through the financial analyzer?
Yes, we put everything through there. We also did a Social Security optimizer on them. And basically, for the pension, they were going to get about, $4,000 a month, but that, not pension, the disability. Right. But the $4,000 was going down to about $2,000 in Social Security, $2,513. So big loss there. June is still making a little bit of income, going to retire, I think, next year. And we put a 2.5% cost of living adjustment on their Social Security. But more importantly, we put a 2.5% increase in expenses. Historically, for the last 100 years, it's been about 3.29% is what inflation has gone up. The last now 10 years only been about 2, but the last 30 has been about 2.5. I don't care what happened in 1918, I'll be honest with you. But the last 20, 30 years are going to tell me something. So we put in 2.5%. Anybody tells you there's going to be 15, 20% inflation is trying to scare you to sell you something. And just remember that. They're trying to scare you to sell you something.
At 2.5%, it increases. The expenses increase pretty quickly.
Yeah. And this is what we're doing is we're trying to get you to realize, all right, if you got $5,000 a month in bills now, what's it going to be later? Okay. So these people didn't want any risk or very little, but they were taking about a 50-50 portfolio, 50% stocks, 50% bonds or CDs, stuff like that. Next thing we do is we stress test it. We're going to make it 0 to 2%. Why would we use 0 to 2%? Because from 2000 to 2010, the market made zero. From 2000 to 2015, it made 4.24%. And you can take little snippets in there. It might have made 12% a year during snippets. So if we know long-term over 10-year periods, it can make zero. That's how we need to stress test it. Knowing that if the market were to go down, obviously it's worse. But long-term, it's hard to lose if you're staying with something really long time, not getting in and out and all that kind of stuff. Their expenses, remember they had about $1.1 million. Their expenses are about $6,300 a month. That's after taxes, $6,300 bucks. So if you're trying to figure that, what's that, 6% of the million? Yeah. But they got Social Security, so it might be 3 or 4%. So you're like, okay, they're fine. Remember the 4% rule? If you take out 4%, the only thing it didn't do is factor in inflation. So we put all of this in the analyzer. Talked about future cash flows, what we're going to say. Let's say the house is going to be paid off in 3 years. We got to put that in there. We're going to put the effects of our Social Security optimizer into it because they thought they were going to get this amount. We showed them how to get 30% more Social Security. So now we can put those numbers in to see what they actually do. And then we're also going to show, all right, what's the effects of taxes? If you're taking money out of specific accounts, some are more taxable than others, right? Some have capital gains, some have ordinary. Our analyzer does all that for you. And we're going to talk about that more when we return from the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Today we're doing a case study. We're talking about a couple that came in our office, Joe and June from Plano. I have changed the names to protect the innocent.
$1.5 million portfolio?
No, $1.1 million.
$1.1 million.
And they came in, they said they needed about $6,500 bucks a month in bills. They were getting about $3,000 from Social Security. Didn't have any pensions.
That's halfway there.
And so you think about it. You need $3,000 a month, right? Approximately, to cover your expenses beyond Social Security. $3,600 a year. If you just did simple math, which everybody seems to do, think about $1 million. How long is it going to last when you're taking out, say, 40,000? It should be 20 years, right?
40,000 a year. That's right.
Yeah. A little bit more because you're only taking out 36. But that's when you forgot to factor in inflation. And so normally we'd have that. Well, what had happened? Remember, June was 62.
Still working, 65. Right?
That's right. She's still working, but you're going to retire soon.
Got it.
We ran the analysis and showed what the expenses would be. Social Security with cost of living adjustments increases.
Yep.
All right. How much would they have if we stress test this portfolio? They went completely broke at 84 when he was 84 and she was 80.
And how much?
A little bit before his 85th birthday.
And with that program, completely broke and $3,000 in income. Well, whatever the increase is.
The cost of living adjustments for that, their Social Security would actually be up to $4,900 at that time from $3,000, 20 years earlier.
And expenses offset that was?
The expenses are $9,800. That $6,000 has turned into almost $10,000.
Got it.
And that's just 2.5%. Anybody tells me that inflation doesn't exist, hasn't ever shopped at a grocery store. You go to, I remember, like I said, my grandparents, they go get me to go pick up a chicken. They said, make sure, they always make fried chicken on Sundays.
It was a big deal.
That's right. Pick up the one that's not cut up.
That's right.
Because that's 50 cents. They try to charge like $2 for them cut up ones. Don't you dare get the cut up one.
That's right.
I'll cut it up right here at the table. I remember my grandpa had to cut them up because grandma didn't know how to cut them, right?
That's funny.
Had to cut it up. And now, go try to see what a whole cut-up chicken is right now. It might be $15. Everything is like that, and it will continue like that until we die, unless, for some reason, the electric company has said, I feel sorry for people. We're going to start lowering your electric bill. And your water bill, too. We got plenty of that water. We're going to lower that, too. And healthcare costs, let's cut those in half. It's not going to happen. You have to factor this stuff in. So by doing this analysis, we showed they're going to run out at 84 and 80. I don't care if your parents didn't live to 84 and 80. That's something you need to address. Because remember, this is with no losses. You make one investment decision that's bad, it's way before this. One down year costs you 4 to 5. So if you went down 20% one time, you could delay your retirement 4 or 5 years.
Well, think about it. $200,000, they're drawing $40,000 a year. Simple math. How many years? That's 5 years worth of income.
Right. So what we did was we gave them a guaranteed income solution. In this case, we had to take about 60%, about 55% of the assets and put them in a guaranteed income solution. Normally, if you plan a little earlier, because they're about one's already on disability, retired, and the other one's about to retire in a year, you have to take a little more. Sometimes you take 10%, 20, 30, if you're planning more. It just depends on if you plan earlier, you can put less towards the guaranteed income solution. But this particular plan gave it to them. Now, what I did was we delayed the income and the Social Security until 70.
Perfect.
And you're thinking, wait a minute. That means I'm about to spend my savings because they're retiring now, right? For 4 or 5 years. People don't like doing that. They're like, wait a minute. But what it did for them.
What's the end result?
From 70 on, they had positive cash flow. The power of positive cash flow during your retirement. In other words, I got 10 grand a month in bills, 12 grand's coming into my bank account every single month. That is a retirement that psychologically you can live with. You don't worry about inflation. This is positive cash flow through their entire retirement if they both live to be 100. And that's with inflation. Some of their bills will be up to $12,000 a month, still being able to pay for it with positive cash flow because we not only gave them a guaranteed income stream, we gave them an increasing income stream. And it increased with inflation. So now they've got, not only is their retirement income being increased, their Social Security's got cost of living adjustments, their guaranteed income solution has increasing income. So they might have started with $4,300 a month from the guaranteed income solution by using 55% of their money. But it was up to $9,000 by the time they died.
Is this the new product that just came out March 1st?
Guaranteed increase, yeah. It's
your
the
income
best increasing product I've seen as far as they go. I could explain the difference. You
need
want to call in, but
you need to take a look at this. It just came out March 1st. I'll let Victor go through his case study. But your income is usually static with these income solutions. This increases commensurate with what the market does. So you get an inflation hedge as well.
Right. And so what we've taken a couple that stress test their portfolio run out at 84 and 80. Now, let's say you say our stress test is too tough. 0%. No way I'll make less than 2 or 3. We did that too. It lasted a couple more years.
That's all.
When you got 10 grand a month coming out of something because your bills have gone up from 6 to 10, it will drain it. It got them a couple more years. Now we got them to living to 100, and the money was almost as much as what they started with. Because since the guaranteed income solution and the Social Security are more than paying their expenses, everything else gets to grow for the rest of your life instead of going down. Because I'm telling you, psychologically, if you've got, I don't care if you save $10 million, $20 million. If you know you're spending $1 million a year or whatever it is out of it, and you know it's not, it's depleting your assets that you worked all your life for, it is a stressful thing. But if you know, I've got this particular piece, whether it's 20% of my assets towards the guaranteed income solution, that's paying all the bills. This other